Well, we are back on MorningLine. Thanks for joining us. Nick Barris along with Dr. Friday Burke. She's our financial tax consultant, and we're taking your calls and questions on the Plus. If you'd like to call in, some lines are open. We also, as usual, are streaming when she comes on Facebook at newschannel5.com. That's where we get a lot of the questions.
Yes.
A lot of people, it's easy for them when they see us on the air
Sure.
to message us. We got a couple here. We'll just bounce through. Wanda, what about $600 from Venmo, PayPal, when people are selling yard sale type stuff on those things?
Those kind of things are fine, but if you're doing more than, and I think someone told me it was either more than 30 transactions, and don't hold me exactly, or like $10,000, either or, you can get what's called a 1099-K, which then becomes income, because the business, they're considering you a business if you're doing that many transactions. So even if you're doing a ton of small ones, you could end up being classified as a business. And the trick to that is, guys, is tracking whatever you're selling. Like if you're taking your used clothes and selling them on the internet, I don't know about you, but I don't save every receipt for every piece of clothing I've ever brought. So you would normally have a loss in that kind of situation, but if you don't have receipts, the IRS says your cost basis is zero, which means all of that could become profit. So if your idea is you're going to start doing that, you might want to keep a folder of your receipts. Just start saving. If you're going to garage sales, buying stuff, keep a cash book and you write down where you brought it, how much you purchased it for, because the government is pushing more people towards business, because a lot of people kind of had their own businesses online that they were kind of doing under the radar.
Right.
And so the government's getting smart, right? They're saying, hey, if you're selling, 365 days a year, a bunch of clothes, at some point, this is a business. Even if it's just your own used clothes, how much used clothes can you have if you've been doing it for a number of years?
Right.
So,
they
you're
pick up on that. They'll see the trends. They know what to look for.
They're seeing trends and they're seeing these kinds of things. And so just keep that in mind. And of course, Venmo, PayPal, all of those are outside banking accounts in essence. So again, those are being reported to the IRS. So don't think because you have a couple $1,000s in Venmo that if you get a tax levy that the government doesn't know about it. They do know about it.
They know about it. And again, pay attention. I use Venmo for paying back someone who bought me pizza the other night.
Absolutely.
Now, little things like that.
Well, my renters all pay through Venmo.
Oh, yeah.
Yeah,
okay.
It's easy.
All right. One other thing I want to bring up, as we know, they've legalized online gambling in
Absolutely.
Tennessee. If you didn't know it, it means you live under a rock, because there are these ads running non-stop everywhere. And I'm not going to get into how I feel about that, but everyone talks about how it's a no-risk bet and everyone's winning. No. If everyone was winning, they wouldn't be spending millions advertising. You gamble on a regular basis, you will lose. Period. End of story.
And it's funny because, and let me tell you the tax side of that. Okay, let's say you do win a big winning.
That's what I was going to get to.
So we win. I got a guy that said he won $300,000.
Okay.
Okay, he did this online. He gambled and he spent about $400. You get one of those big winners, right? He wins, but he's a constant gambler. He's already spent most of that money back on other gambling things. He's like, well, I'm gonna break even. I said, no, because what happens is you can write off on your Schedule A, which is a reduction of your deduction. So you can deduct $300,000 against a $300,000 if you have it. But it's not dollar for dollar, because you're going to still end up with taxable income. So no matter how you do it, you can only wash off as much as you had in losses. Now, if you lose every single dollar, it still has to run through the A, which means it has to be falling onto the tax return. You might get down to zero, maybe, but the fact is, in most cases, people can't justify all those losses. Now, a lot of times they have the cards, and they'll say, well, I've been doing it for 3 years. You can't do it for 3 years. It's what happened in the year that it happened. So you may be a constant gambler, lost millions of dollars, you win 300, and I'm like, oh, I never made any money. Not so. In the year you made 300, he only spent $400 into gambling. This guy made a ton of money.
So I'm trying to just so I'm clear. You can't write off your gambling losses, can you?
You can on a Schedule A.
On a Schedule A,
but
you can write
only write it off to what you earned.
To what you to what you earned in gambling. Okay, I just want so that's the one clip. Otherwise, it's absurd. To me, I don't see why you should be able to write off gambling losses. Period. Frankly,
but a lot of people don't think it should be taxable income either, because they're gambling with after-tax dollars. But
okay, well, I see that. So in that, let's just say you go to Vegas, one time, boom, you nail it, and you win $500,000. How much do you pay in taxes on that? I guess the same thing as if you win the lottery.
Ordinary income, it's all ordinary income depending on the distribution of it. And I mean, of course, in Nevada there is no state tax, but in Kentucky, which we had a lot of people that would gamble in Kentucky, there was also a state income tax on those winnings because they were earned in Kentucky. Now, since Tennessee has opened the online, it's going to be really interesting, and you have to. It's funny only because at the end of the ads they always say if you have a gambling problem, please call gambling.
That's another thing that's
come
amusing
on.
about it.
It's like, it's almost like a catch-22. You know they have probably a gambling problem. Anyways.
Oh, that is part of it. It's like a Saturday Night Live skip. They're pitching the gambling thing, and the last sentence, if you have a gambling problem, call. It's like, come on, you know? Oh, geez.
It's just a little funny.
But a lot of people do it, and you know, if it's your money and it's fine, and I don't begrudge it. But if you think you're going to do it regularly and win regularly, if you're telling me that, I don't believe you.
Yeah.
People, eventually, you're not smarter than the bookmakers, and they're making a ton because they're sure spending millions advertising.
You see Vegas, right? I mean, Vegas is built on gambling. Hello.
So, but if you enjoy it, win or lose, and fine, I don't begrudge anyone doing that. But don't tell me you're getting rich gambling, because I'm not going to buy it. Let's go to Mary. Mary, good morning. Hi, Mary.
Hi. I have a quick question about the Venmo PayPal. So my husband is a musician, and he gets paid for some of his work through PayPal. However, he also gets a 1099 for that money that he's being paid. So how is there going to be a way on the tax part when you're filing out your taxes that you can say, yes, I did receive all this money through PayPal, but I already have a 1099 that I'm paying out of that 1099.
Right. We've actually had that case where we actually had to go into an audit on that particular situation because they were doubling up on the person's income, saying that he wasn't reporting all the income in my case. And yes, there is actually a place on the bottom that we would actually take it off as a double entry. In a sense, we would pick it up as double income, and then we would write it off as PayPal double entry, and we'd actually document it on the Schedule C or whatever form this person's filing to make sure that the IRS knows, yes, we know, but his income is going to look twice as high in theory because we want to make sure we get the 1099K from PayPal and the 1099 from the employer, because first thing they do is match income, period. If they don't see the income at the right dollar amount, they're going to change it no matter what I put on the tax return anywhere else.
Excellent. Hope that helps, Mary.
It's a great question.
How about this one? Someone just asking, Michael, how do we do taxes perhaps in a year after a loved one has passed away?
Right. So in the year that someone passes away, you're still considered married, or that person is still active no matter up to the last day of that year. So if we lose somebody in 2021, you would still file a final tax return. If you were married to that individual, you would still file married on that situation, and then you would close out their, on the return we have a place that we would put date of death, and that person's Social Security then would be closed off at that time for the filing. And I always suggest, no matter if the person never needed to file, always file a final tax return for that person, because it is another way of making sure that Social Security number has been turned off, I guess is the easiest way to put it.
Okay. This one is a little confusing, and maybe you can decipher it. You sometimes see it where I don't. But Sandra's saying, do you still file taxes if you don't only get the stimulus check for yourself with no dependents? You live paycheck to paycheck, you're out of work, you're disabled under a doctor's care, you cannot work right now. Do you file your taxes if you did not get the child tax credit because you're just a single person, just got the stimulus check?
Well, a single person would not get the child tax credit.
Okay, right.
The child tax credit will only come as if there's a child. If you would file if you did not receive the stimulus of $1,400 and you were qualified for it. So that would be the biggest question is if, and again, I was working at a homeless shelter not too long ago, 2 weekends ago, whatever, and I'm going to be doing a ton because many of those people don't file taxes, did not know they were qualified, and did not have the ability. So we need to be getting that stimulus money for them to be able to take it. So if you normally don't pay attention to taxes because it doesn't really apply to you, the last 2 years really probably did apply, unless you were on Social Security and maybe it came through Social Security.
Good to know. You do some help at the homeless shelter with folks doing that. That's
Salvation, yeah.
Good to know. Good for you. Let's go to Marie real quick before we go to break. Marie, good morning. Hi, Marie. Are you there, Marie?
Yes.
How can we help you? Yeah.
Yes. We sold some property and we paid our capital gain, but the IRS, they have cut our Social Security now, mine and my husband's, and I'm wondering why they can do that.
Because you sold property and made some money, and then after you did that, they cut your...
Well, they wouldn't have cut your Social Security. They increased your Medicare, right?
Oh. Do you know, ma'am? Did they increase?
Yeah, we did do that.
The Social Security, assuming that they were over the age, they were in full retirement, they would not have, and even if they weren't, that's not considered earnings for people like we were talking earlier, if you took early Social Security and you were working, if you sell real estate. But what the downside, and people don't seem to pay attention, and it's not like you have a choice sometimes, but Medicare is means tested, which means that as you make more money, they charge you more money. So in this case, they went from basically living maybe on Social Security and a very low, and they were paying the minimum. They sell and made $100,000 or so on this property, whatever it was. Now for another year, they're going to pay a higher Medicare cost because the tax returns showed they made more money. And then after that year, when you file the next year and it gets posted, I always think it's more like 14 or 15 months that you pay it. Once that happens, then they'll reduce it back down to the prior year.
Even though you still have that $100,000,
right?
Perhaps,
I mean, it's only 1 year that you'll have to pay the higher, just the year in which the tax return, or actually the year after you filed that tax return.
Marie, you may not like it, I know, but that's the way it works, and that'll be for that 1 year. So that's the way it's set up.
It is. I mean, it works that way, but there are ways around it. So if you actually have a financial planner or a tax person, you might want to have conversations, because sometimes doing installment plans and different things like that is beneficial, not only to get the higher tax bracket lowered because you're in a multi-month or multi-year, situation, but it also keeps your Medicare lower. So sometimes it works, sometimes it doesn't, but either way, at this point, you can't go backwards.
As we go to the break, I think that's a good point. Not a lot of people necessarily understand this. I've used one, financial counselor, and it's not because I got a ton of money and I'm happy.
Exactly.
But I've done that with some of my parents' affairs as we've dealt with them with their Social Security and Medicare and Medicaid with regard to nursing home care. And, you had to spend a little money. Like, can we really afford to do this right now with this? But you know what? The stuff that this guy did, and it was all above board, saved us a ton of money.
Right.
And I never would have known it on my own. So sometimes it's worth investing in a financial counselor short term to walk you through just what she said.
Yeah, I agree totally, because I think especially if you have a tax person and a financial person, sometimes they can actually save. I mean, we've saved hundreds of thousands of dollars with financial planners. It's well worth it. And I mean, like you say, it's not always. I mean, the problem is if you're on a fixed income, you're like, oh, I don't really have the money. The problem is you don't have any money to lose. So if there's a way of keeping more like them, that may have been their last big piece of property that they need to stretch for a period of time. It may have been smarter to spend $100 to $300, whatever, to get consulting before you sign those documents, because it could have actually saved them thousands of dollars over the next year of not paying. So, it sometimes just doesn't always, math doesn't always add up, but, I'm just going to do it.
It's what the trick is. It's that initial outlay. Like, oh, can I really afford $1,000 or 500 depending on the estate right now? Of course you can't. That's a pain in the butt. But if you do that and it works out, and usually it will, because you can get consulted first, and they'll say, you know what? I think if we get into this, we can save you.
Right.
If you spend $500 now and it saves you $5,000 later, I'm sorry, that's
Great
worth
investment.
it. Find a way to get that money.
Right.
We'll take a break. We'll be back with more. We're streaming live on Facebook at newschannel5.com. Message comments there. I'll share them with her and we'll answer that. Or you can call us 737-7587. Dr. Friday Burke. She knows her stuff. We'll be right back.